There is a moment, right before every major financial collapse in modern history, where the market looks completely fine. The headlines are calm. The indices are near highs. The analysts on television are telling you the economy is resilient. And somewhere, in the quietest corners of the smartest offices in the world, a very small group of people is doing three very specific things. Not because they have a crystal ball, not because they got lucky, but because they have spent their entire careers studying the architecture of financial destruction, and they have learned to read the same blueprint that appears, without fail, before every single crash. Stanley Druckenmiller is one of those people. He has navigated more major market crises than almost any investor alive. He ran money for George Soros during the trade that broke the Bank of England. He generated an average annual return of 30% for 30 consecutive years without a single losing year. 30 years, not one. And the reason he has never had a losing year is not because markets were always kind to him. It is because when markets were about to become brutal, he already knew. He already saw it. And he had already made three specific trades that most investors either never make or make far too late to matter. This video is about those three trades, but more importantly, this video is about why those exact same three trades are being made right now in 2026 by the smartest and most powerful money on the planet at a scale that Druckenmiller himself has publicly stated he has not witnessed since the months immediately before the 2008 financial crisis. Before we get to the trades, you need to understand something fundamental about how Stanley Druckenmiller thinks about markets. Because without this foundation, the three trades look like tactics. With it, they look like what they actually are, which is a complete and disciplined response to a structural reality that most investors are psychologically incapable of accepting until it is far too late. Druckenmiller has said repeatedly, in public interviews, in shareholder letters, in conversations that have been documented and preserved over decades, that the single most dangerous word in investing is the word fine. Not bad, not crisis, fine. Because fine is the condition that exists in the market right before the structure underneath gives way. He has a way of describing what he looks for that is worth understanding deeply. He does not look at the price of assets. He does not look at whether stocks are going up or down on any given day. He looks at whether the relationship between price and underlying reality has become disconnected. And when that disconnection reaches a certain magnitude, when the gap between what things are priced at and what they are actually worth, in terms of cash flow, in terms of sustainable debt, in terms of real economic output, becomes too large to be maintained, he knows what comes next. Not because of instinct, because he has seen it before, many times, and the sequence is always the same. In 1929, the American stock market had been disconnected from economic fundamentals for years. Stocks were priced at valuations that assumed infinite growth in a world that was already showing cracks in agricultural output, in industrial demand, in the credit structure that was holding the whole edifice up. The crash did not come from nowhere. It came from the accumulated weight of a structure that had been deteriorating for years before the first visible fracture appeared. In 1987, markets had run up on a combination of leveraged buying and a new financial instrument called portfolio insurance that turned out to work in exactly the opposite way from what its designers intended under real stress conditions. The crash of October 19th, which remains the largest single-day percentage decline in the history of American markets, did not arrive as a surprise to everyone. The people who understood the leverage in the system, the people who understood what portfolio insurance would actually do when prices started falling, were already positioned They were already out or they were already short. In 2000, the technology bubble had inflated to valuations that required a suspension of every known principle of financial analysis. Companies with no revenue, no path to revenue, and no coherent business model were trading at multiples that would have been impossible to justify even for the most profitable enterprises in human history. Druckenmiller himself watched his own portfolio managers begin to believe the new paradigm story. He tells the story of a senior analyst walking into his office and telling him that traditional valuation models no longer applied, that the internet had changed the fundamental rules of what a company was worth. Druckenmiller did not argue. He did not pull out a spreadsheet. He said one thing. He told his analyst that he had heard those exact words before. Different asset class, different decade, same sentence. And every single time those words had appeared, the fundamentals had eventually returned with a violence that destroyed everyone who had convinced themselves they were gone for good. In 2006 and 2007, the housing market was pricing in an assumption that home values would rise indefinitely, that the mortgages being issued to borrowers who had no income and no assets and no realistic prospect of repayment would somehow perform, that the bonds constructed from those mortgages and rated AAA by agencies that either did not understand what they were rating or did not care were worth what the market said they were worth. Druckenmiller was already in his first trade before the majority of the financial world acknowledged there was a problem. He moved to cash. He reduced exposure. He built reserves. And when September 2008 arrived and the system came within hours of complete collapse, when Lehman failed and money market funds broke the buck, and the entire global financial architecture shook, Druckenmiller was sitting on dry powder while the rest of the world was desperately trying to find anyone willing to buy the assets they needed to sell. So what are the three trades? The first trade is the move to cash. This sounds simple. It is not. The move to cash is psychologically the hardest thing a successful investor can do because it requires you to accept underperformance in the short term with absolute conviction that you are correct about something that the majority of the market is currently disagreeing with you about. When Druckenmiller moves to cash, the market is usually still going up. The people around him are usually making money. The news is usually good. The confidence is usually high. And he is sitting in cash, watching the rally he is not participating in, holding firm to an analysis that says the foundation beneath the rally is cracked and deteriorating, and that the price of staying in will eventually be far higher than the opportunity cost of staying out. He executed this trade in 1999, and 2000 as the NASDAQ continued climbing toward its peak. He watched companies with no business model go from $100 million valuations to billion-dollar valuations in months. He watched the people who disagreed with him make extraordinary paper gains. And then he watched the NASDAQ fall 78% over the following 24 months and never returned to its peak for 15 years. The people who called him conservative were bankrupt. He was not. Joseph Kennedy, father of President Kennedy, made the same trade in the summer of 1929. While Wall Street was still euphoric, while the bulls were still loud and the bears were still being ridiculed, Kennedy was quietly and methodically converting his equity positions into cash. His own account of what prompted it is telling. He was getting stock tips from a shoe shine boy, not because shoe shine boys are unintelligent, but because when everyone, including people with no framework for analyzing financial assets, is buying stocks, it tells you something critical about how much of the available buying power has already been deployed. There is no one left to buy. The only direction remaining is down. Kennedy was in cash 6 months before Black Thursday. Paul Tudor Jones was in cash by early October 1987, weeks before Black Monday. The investors who built the greatest wealth from those crashes were already out of the market before those crashes became visible to anyone who was not paying close attention to the structure. Now look at what is happening today. Warren Buffett, the single most closely watched long-term investor alive, is sitting on $325 billion in cash. That is not a rounding error. That is the largest cash position in the history of Berkshire Hathaway in absolute terms and as a percentage of total assets. He has been selling stocks for over a year. He cut his Apple position nearly in half. He has been systematically exiting major financial sector holdings. He sold Bank of America. He trimmed positions across his portfolio in a sequence and at a scale that has no precedent in his 5-decade record as a public company. And in his most recent letter to shareholders, he wrote that he cannot find anything attractively priced. Read that sentence again slowly. The man who has spent 50 years finding undervalued companies in every kind of market environment, through recessions, through wars, through crises of every variety, cannot find anything attractively priced. That is not a passing comment. That is a statement from someone who has navigated this cycle before and is telling you, in the clearest language available to him, where he believes we are. Corporate insider selling is running at levels not seen since 2007. These are the people who run the companies. They see the order books 3 months out. They know what the next fiscal year looks like from the inside. They are converting their equity compensation into cash at a rate that has historically preceded significant market dislocations. When the people who have the most complete information about a company's future prospects are selling their shares, that is not noise. That is signal. The first trade is being executed right now at a scale that has never existed before in the history of financial markets. But here is the problem that the first trade creates, and this is the insight that separates Druckenmiller's framework from a simple defensive posture. When you move to cash to protect yourself from a market collapse, you have solved one problem and quietly created another. Because every single major financial crisis in modern history has been followed by the same institutional response. Rates go to zero. Money gets printed. Enormous quantities of new currency get created in an attempt to stabilize asset prices, prevent bank failures, maintain consumer confidence, and avoid the political consequences of a genuine economic contraction. And when that happens, the purchasing power of the cash you so carefully protected starts eroding. Sometimes gradually. Sometimes at a pace that genuinely shocks people who thought they had been prudent. In 2008, the Federal Reserve cut rates to zero and created $4 trillion through quantitative easing over the following years. In 2020, they created $5 trillion in 6 months. Inflation followed. In both cases, the people who held only cash avoided the immediate market collapse, but quietly lost purchasing power in the recovery. They avoided being destroyed by the crash, but got slowly eroded by what came after. You avoided the fall only to get quietly diminished by what followed it. This is the problem the second trade solves. And the second trade has been running visibly for more than 2 years, in plain sight, if you know where to look. The second trade is the accumulation of gold, not as a speculative bet, not as a hedge against some specific scenario, as a structural position against the debasement of paper currency that reliably follows every major financial crisis in modern history. Druckenmiller himself has held gold at every major inflection point in his career. Paul Tudor Jones held gold exposure through the 1987 crash, specifically as protection against the rate cuts and liquidity injections that he knew would follow. John Paulson, who built one of the most famous short positions in financial history against the housing market in 2007 and 2008, simultaneously accumulated enormous gold exposure because he understood that the Federal Reserve's response to the crisis he was betting on would involve creating enormous quantities of new currency. He was right on both counts. Gold moved from approximately $700 per ounce in 2008 to nearly $1,900 per ounce by 2011, a gain of more than 170% during the exact years when the Federal Reserve was most aggressively debasing the dollar. The people who held only cash protected themselves from the crash but lost purchasing power in the recovery. The people who held gold did not. Now look at what is happening today with gold. Central banks around the world have been buying gold at a pace not seen since 1967. China's central bank has added to its gold reserves every single month for over 2 years without a single interruption. The People's Bank of China is the institution responsible for managing the world's second largest economy, and they have been buying gold every month for 2 consecutive years. Turkey has been buying. Poland has been buying. India has been buying. Singapore has been buying. Dozens of sovereign nations are accumulating gold at historically elevated rates. In 2022, central banks collectively purchased more than 1,000 tons of gold, the highest annual total in over 50 years. They matched that pace in 2023. The trend has not reversed. These are not retail investors making emotional decisions based on fear or fashion. These are the institutions that understand currency debasement more precisely than any other entity on earth, because they are the ones responsible for managing it. They know what the playbook looks like from the inside. When the people who run the printing presses are accumulating the one asset that cannot be printed, that tells you something specific about what they believe comes next. The second trade is being executed right now at sovereign scale, which brings us to the third trade, the trade that separates the investors who merely survive from the ones who build lasting wealth from the collapse itself. The first 2 trades are defensive. They protect your capital and preserve your purchasing power. The third trade is offensive. It is a position specifically structured to generate returns, not if things stabilize or recover, but precisely because they fall. This is the trade that turns a financial catastrophe into a wealth-building event for the people who have the foresight and the conviction to place it before the crowd understands what is happening. Paul Tudor Jones spent September and early October of 1987 carefully building put option positions timed to expire during the crash window he had predicted in written memos to his own investors. He documented his analysis. He told people what he believed was coming. And then he built positions that would pay off specifically if he was right. On Black Monday, October 19th, the market fell 22% in a single session. Jones's positions went from a few $1,000,000 to over $100 million in a single day. Not luck. Pattern recognition translated into precisely placed positioning. Michael Burry spent 2006 and 2007 buying credit default swaps on subprime mortgage bonds, while his own investors demanded their money back and industry veterans dismissed him as confused about how the system worked. The arithmetic was clear to him even when it was invisible to everyone else. The mortgages were being issued to borrowers who could not afford them. The bonds built on those mortgages were going to fail. When they did, his positions paid at levels that seemed impossible to those who had not done the same calculation. He converted a few $100 million into several billion. John Paulson built a dedicated fund specifically to execute this trade at scale. When 2008 arrived, that fund generated $15 billion in profit in a single year, while the global financial system came within hours of complete collapse. Druckenmiller himself has deployed short positions and volatility instruments at every major inflection point of his career. At each crisis he navigated personally. His positioning allowed him not just to avoid losses, but to generate significant returns while others were being destroyed. That is not luck repeated across 4 decades. That is a discipline applied consistently to a pattern that keeps repeating. Right now, institutional options activity is showing sustained and significant positioning in large downside bets on major indexes and on vulnerable sectors. The volumes are not consistent with routine portfolio hedging. Large amounts of capital are being systematically and deliberately positioned to profit when markets fall. This is not speculation about what might happen. This is observation of what is already happening. The third trade is being placed right now in real time by people who understand the same pattern that Druckenmiller has spent 40 years studying. Now here is the element that makes 2026 different from every previous cycle. The single factor that changes the calculus for what comes next in a way that Druckenmiller himself has publicly called unprecedented in his career. Every previous financial crisis had one reliable emergency exit: the Federal Reserve. In 1987, they cut rates and flooded the system with liquidity. Crisis resolved. In 2000, they cut from 6% to 1% over the following 2 years. Crisis resolved. In 2008, they cut to zero and created $4 trillion. Crisis resolved. In 2020, they created $5 trillion in 6 months. Crisis resolved in weeks. The playbook worked every single time. And it worked because every single time the Federal Reserve had genuine room to move. Rates were high enough to cut meaningfully. The balance sheet was clean enough to expand aggressively. Inflation was low enough that printing money did not immediately create a visible secondary crisis. This time, that emergency exit appears to be blocked from both directions simultaneously. Inflation is still running above 3%. If the Federal Reserve moves rates back toward zero right now, in response to a market collapse, inflation does not drift gently upward. It accelerates, back toward the kind of numbers that destroy the financial security of ordinary households within months. The traditional rescue cannot be deployed without triggering a different crisis. But if rates stay elevated, the interest burden on nearly $36 trillion in existing government debt becomes increasingly catastrophic with every passing quarter. The United States already spends more on annual interest payments than on its entire national defense budget. As old bonds mature and get refinanced at today's higher rates, that number does not hold steady. It climbs. And the higher it climbs, the more new borrowing is required simply to cover the cost of the debt that already exists. A spiral with no natural exit point on the current trajectory. Druckenmiller has called this the credibility trap. For the first time in 4 decades of studying these cycles, the institution that has reliably rescued markets in every previous crisis is operating with genuinely constrained capacity to act. The escape hatch that worked 4 consecutive times may not be available in the same form this cycle, and markets have not yet fully priced in what that means for the duration and severity of the correction that follows. When you place all 3 trades together against this backdrop, when you see the historic cash accumulation by the largest and most sophisticated investors in the world, when you see the sovereign scale gold buying by the central banks who understand currency debasement from the inside, when you see the institutional volatility positioning in options markets at levels that are not consistent with routine hedging, and when you read all of it through the lens of 100 years of financial history and through the specific framework that Stanley Druckenmiller has spent 40 years refining, The picture that emerges is not ambiguous. It is not a matter of debate among people who are paying close attention. The same blueprint that has appeared before every major crash in modern financial history is being drawn right now in real time by the most informed and best resourced actors in the global financial system. The investors who understand this pattern early enough to position before the crowd will not be the ones paralyzed by fear when the structure finally gives way. They will be the ones who built cash when others called it lazy and conservative. They will be the ones who accumulated gold when others called it an outdated relic with no yield. They will be the ones who placed volatility protection when others called it pessimistic and overcautious. And when quality assets become available at panic-driven discounts, as they always do in the aftermath of every major collapse, they will be the ones with the capital and the composure to act while everyone else is still trying to figure out what happened and how to survive it. The preparation window is still open, but it does not stay open indefinitely. The one consistent lesson from every major crash of the last 100 years, the lesson that runs through 1929 and 1987 and 2000 and 2008, and through every other structural dislocation that Druckenmiller has studied, is that the time to understand this sequence is always before, never during, and certainly never after. The people who act after have already lost the most important part of the opportunity. The people who act during are reacting under pressure with incomplete information and deteriorating options. The people who act before, the ones who took the pattern seriously when it was still a warning and not yet a crisis, are the ones history records as having navigated it correctly. Druckenmiller has spent 4 decades building the discipline to act before. Not because he enjoys being early, not because being early is comfortable, because the cost of being late in a structural market collapse is not measured in missed returns. It is measured in the kind of permanent capital destruction that takes years or decades to recover from, if it is recovered from at all. The 3 trades are not a guarantee. Nothing in markets is a guarantee. But they are the same response, executed by the same category of investor, in the same sequence, across 100 years of financial history. And right now, in early 2026, all 3 of them are being made simultaneously, at a scale and with a specificity that has not appeared since the period immediately before the last great collapse. That is what the smart money is doing. That is what the pattern looks like. And now you know what most people, the vast majority of investors who will be surprised when the structure finally breaks, have not yet taken the time to understand. If this analysis gave you something genuinely useful today, subscribe to this channel. Every video here is built on real research, real numbers, and the kind of long-term pattern recognition that does not come from chasing daily headlines or reacting to the news cycle. It comes from studying the structure. Leave a comment and tell us which of the 3 trades you believe is the most significant signal right now. The cash accumulation, the gold buying, the volatility positioning. We read every single comment. And if you know someone who needs to see this analysis before the window closes, share this video with them today. This video is produced for educational and informational purposes only. It is not financial advice, and nothing presented here should be interpreted as a recommendation to buy, sell, or hold any asset. All historical data and figures referenced are based on publicly available sources. Always conduct